Good afternoon, everyone, and welcome to this call from Edelweiss Mutual Fund. We are at a very interesting phase of market right now, and there are many investing opportunities that are coming way to our investors and distributors. To discuss one of these opportunities today, we have with us Trideep Bhattacharya, CIO for equities, and Mr. Ashwini Agarwala, who is a fund manager and analyst for financial services segment. Today, we are going to decode this exciting opportunities that we have in the financial services space and also talk about the fund that we are launching in the space and what opportunities are there and what how people can or how investors can participate in this opportunity. So first of all, Trideep, over to you to discuss broadly a bit about markets and then your overview on financial services as a segment.
Um, Good evening, everyone, and wish everyone a very happy new year. What I plan to do over the next five odd minutes is, Ashwini, go back to the previous slide, is that I would take you through what very briefly our market outlook is and try and see if financial services fits in that market outlook overall, and where does it fit in the context of markets. And then Ashwini will take it over from there with more nuances about the sector, and then we will pause for Q&A. So starting with equity market outlook, in my opinion, one of the big positives that we have today as opposed to 12 to 15 months ago is that finally we have earnings upgrades starting to come through. Over the last 12 to 15 months, India has seen material amount of earnings downgrade to the tune of about 12 to 13%, which started reversing as of September quarter. But what we now observe is that even for the December quarter and March quarter, 2 or 3 quarters of back-to-back earnings upgrades might actually stand to come through in the context of India. If you look at the numbers that have come through for the December quarter, it looks fairly decent. So net-net, we are at the cusp of earnings upgrade cycle. The strength of it and the longevity of it will obviously depend on how the global markets and global scenario pans out. But directionally, after a good 12 to 15 month break, we are finally entering the earnings ladder in the right direction. In my opinion, this earnings upgrade cycle would be led by two sectors in particular. One is consumption, a sector which is partly played out in calendar year 25 and will partly further play out in calendar year 26. You might recall that we launched a consumption fund roundabout beginning last year, saying that consumption could be the dark horse of calendar year 25. That's worked out reasonably well. The fund is up about 15-16% in absolute terms. And we think in a market which is broadly flat, it's worked out well for investors who participated in this fund's journey so far. We think that furthermore, in calendar year 26, consumption could have a few more days in the sun, given that the 8th Central Pay Commission is roundabout in the corner. And overall, we think that we will be able to kind of, see a better outlook coming from the consumption sector as well. The second sector which we think would do well in the next 12 to 15 months is financial services sector. I think is at an inflection point. Ashwini, if you could move on to the next slide. We think that the reason why we are calling out of at an inflection point is overall, one, the fact that over the last 5 years, the sector has underperformed. And along with that, the sector is at a very reasonable valuations of relative 3 to 5 year low on the price to book as well as on price to earnings ratio. That combined with the fact that we are finally seeing credit growth turn around makes actually the cyclical case of financial services as a sector quite well for from a broader market standpoint. And hence, if you look at majority of our portfolio, whether it's the flexi cap fund or the ELSS fund or the large and mid cap fund or the mid cap fund, across portfolios, we are actually overweight financial services over the last 2 or 3 months, and we think there is clearly more room to go as the financial services sector crosses through this inflection point. Better days lies for the sector in the context of the broader markets. And what this means is across different segments of financial services, which is quite a broad spectrum, the range of performance would be good to better rather than, clearly not up to the mark what we have seen over the last 5 years. Now, the thing is that financial services as a sector is a fairly heterogeneous and broad-based sector. On one hand, we have lending vehicles like banks, as in the private sector banks, public sector banks. We also have non-banking financial services companies, insurance companies, credit card companies, wealth management companies, AMCs, and a fairly broad basket of segments. All of them have different triggers within themselves and give a good account of themselves generally when the credit growth environment improves. While this is a 30,000 view, let me invite one of my colleagues, Ashwini, who would be running this fund, to talk a bit more about what we mean by attractive valuations and where do we stand on underperformance, what are the main catalysts that he expects over the next 6 to 12 months, and is there a structural case of different segments of financial services? So with that, Ashwini, over to you. Ashwini is one of our colleagues who has close to 20 years of experience in financial services in different shapes and forms, in sell side and buy side, and we couldn't find a better person to run this fund, and that's the reason he will be running these funds along with myself. Over to you, Ashwini.
Thanks a lot, Trideep, and I welcome you all. So we just start with the overall performance of the BFSI sector as compared to the broader index. If you look at for the last 15 years, you see the chart on the left-hand side where the dark blue area is above the light blue area in all those years, right from 2012 and from 2014, BFSI sector has outperformed the broader index for a good period of roughly 8 to 9 years. And then from 2022 onwards, it underperformed the broader index. And if you see last 1 year, it has again started to outperform the broader markets. The last 5 years of underperformance has come because if you see starting 2020, when COVID struck, the central governments across the globe had increased their fiscal deficit, and specifically in India, a lot of thrust was given for employment generation or to keep the employment intact. That's why the fiscal deficit increased from 3.3% to 6.7%. And a lot of that money, or rather most of that money, went into the infrastructure sector, railway sector, defense sector. The first two sectors are employment heavy, which really helped the performance of those sectors. Now, if you see the 5-year rolling returns for the last 15 years, the 5-year rolling returns were always positive for the BFSI sector or above the broader index, except for the last 2 years, I would say. The chart on the left-hand side, the area which has marked circled. And if you look at the rolling returns, 5-year rolling returns over a period of 15 years, the BFSI segment has outperformed the broader index in roughly 82% of the time. And if you look at 7-year rolling returns, it has outperformed by 86% time. And if you look at 10-year rolling return for 15-year period, the BFSI segment has outperformed the broader index roughly 92% of the time. So that is the kind of outperformance you see in the BFSI segment. Now, as Trideep talked about, the valuation of BFSI is cheap within itself. If you look at the 5-year or 8-year view, the overall valuation or 8-year valuation has been 23 or 23 and a half somewhat, but currently it's trading at 19.5 times. Now, within the BFSI segment, if I were to break the valuations based on PE, most of the PSU banks are trading at sub 10 PE, whereas private banks are in the range of 10 to 15 PE. And it is the capital markets where there is higher growth, higher ROE, and higher cash flows. They are trading anything in between the range of 25 to 40 P. So it is the capital markets which have increased the valuation of the entire sector. But within the sector, if you compare the segment with itself for the last 8 years, and if you compare this sector with other sectors, the valuations are very attractive in PE terms. Now, if you look at in price to book terms as well, so average has been roughly 3 times, 2.94 to be precise, and currently it is trading at 2.7. If you look at other sectors compared to BFSI sector, the other sectors are substantially expensive. If you look at the valuations of whether cap goods or any infrastructure or Nifty 50, Nifty 200, Nifty 500, the valuations of BFSI sector is comparatively cheaper. Now, I'll show you the performance of various sectors for the last 15 years. Except for 2 years of 2011 and 2015, the BFSI segment has given positive returns throughout. And as I said earlier, that from 2020 to 2024, the other sectors did well because of the fiscal impetus by the government. That's where you see the other sectors, especially the infra-driven sectors, doing really well. So 2025 was the year of inflection, where the growth in fiscal deficit, or rather the growth in capex by the government, was on the lower side. And hence, those sectors did not perform that well, but still they give decent returns. But here in financial services outperformed the broader market by good 22%. The Nifty 500 gave you a return of negative 2%, but whereas the financial services gave the return of 20%. Now, if you look at the macro list, why did the BFSI sector did not do well? First was the fiscal deficit. And if you see the last, let's go back to 2023. First, I'll take you to this chart. So in 2023, if you see, the loan growth was in the range of 18-19%, and a lot of excesses were being created because of easy liquidity by the central government. The inflation was also around about 6 to 7%, which was way above the comfort range of RBI of 4%. Hence, the government and the central bankers decided to roll back the easy policy. The liquidity, which was around about 8 lakh crores to 9 lakh crores positive in the system, came down to 1.5 lakh crores negative to roughly 2 lakh crores negative in the system. And that has again become positive since April 2025. The interest rates, if you see, the interest rates were raised in a jiffy by roughly 250 basis points. The blue line, that is the repo rate, to roughly 6.5%. And in last 1.5 years, or rather 1 year, the rate cut, if you see, has been quite sharp because interest tamed. And we had 150 basis points of a repo rate cut. The short-term rates were cut by roughly 150 basis points. The long-term rates declined by roughly 100 basis points. So these rate cuts or these reduced rates really help a consumer in a lower EMIs and lower down payments. Now, this is the liquidity which I was talking about. The liquidity was as high as 10 lakh crores at one point of time, and that was decreased to roughly 2 lakh crore negative. So that had caused the slowdown in the earnings. It was not an external cause, the slowdown in the earnings or slowdown in the BFSI segment. It was very much planned by RBI and the government. Now, if you look at what are the mega trends in the overall system, now, out of NSE 500 or BSE 500, roughly 95 companies are there which fall in the BFSI segment. Out of that, 43 are lending companies, 26 would be bank in the bank, and roughly 15 would be NBFCs. So I'll give you just a brief update here about the total size of the NBFC system is 47 lakh crores. The banking system is 195 lakh crores. NBFCs lend to the segment where banks do not lend or are unable to lend because of regulatory requirements. Businesses which do not have a proper return or their bank statements do not reflect the proper cash flows which those businesses have or the profit which those businesses have. The NBFCs tend to lend to them. They'll do auto financing, loans. And since that overall size is smaller as compared to banks, it is roughly 25% of the banking system. They tend to grow a little faster than the banks. If you see the growth of the banking system, currently is at 13%, but whereas NBFCs are growing anything in between 15 to 22, 23%. And some NBFCs are also growing in the range of 24 to 25% because of the smaller size and the underpenetration in the segments where they are present. Private sector banks, they have been gaining market share over the PSU banks in the last 20 years. If you look at the private sector banks, they would be having a roughly market share of 35% in the overall system. And if you look at, there were earlier roughly 21 public sector banks. Out of that, 9 have been merged, and currently there are 12 public sector banks. So if you look at the overall lending system, we think that there is a good headroom to grow for the next 10 to 15 years in India because of the various structural drivers which we have currently. If you look at our population, 70% of the people are below the age of 35. And as these people grow, they will require education loan, housing loan, two-wheeler loan, loans. They will tend to invest in various asset classes. And the NBFCs and banks are in a very sweet spot to grow the entire book roughly at currently, if you see, our overall book is 195 lakh crores and our overall GDP would be 400 lakh crores. So our banking system to GDP is less than 50%. And if you look at the other markets, whether emerging markets or developed markets, this number is 100% or more than 100%. So that is the kind of growth which is possible in the overall lending system. Now, within the three segments of NBFCs, PSU, and private banks, NBFCs tend to grow faster because of the smaller size. PSUs are really well poised. If you see, in the last 15 years, they have the best of the balance sheet in terms of capital adequacy ratio. All the NPAs have been cleaned up. They have the best of the NPA ratios and best of the return ratios. The current return ratios of most of the PSU banks are in the range of 1% to 1.1%. This number lastly was seen in 2011. The overall banking system is in the best of the place from all parameters, whether you look at ROA, ROE, capital adequacy ratio, and NPAs. Most of the banks, especially in the PSU category, less than 15% of their operating profits is being used in making provision. And that number was as high as 60, 70% 5-6 years back. Now, if you look at the overall comparison between US markets and Indian markets, the BFSI segment, currently 54% of our entire BFSI weights is in bank. This number was 75% 10 years back. And as we grow as an economy, as we develop more and more people, and as the financial system develops, people will find different avenues to save and different avenues to borrow. Earlier, 10 years back, most of the people, the financial savings were either in pension fund, fixed deposit, savings deposit. Today, savings account gives you a 2.5% return on a fixed deposit. Roughly, you make 5 to 6%, give or take, and then you have to pay tax at the marginal rate. Whereas people have realized from 2020 post-COVID, due to change in the behavior, that equities on a long-term basis can give you real returns which are over and above your inflation. None of the asset classes or any savings vehicle currently give you returns which can beat the inflation. Now, if you look at overall banking weightage has gone down from 75 to 54. The financial services, which is basically the NBFCs, they have seen a sharp growth, and their weightage has increased from 19% to 26%, because earlier they were mostly into housing finance, vehicle finance, consumer durables, and in the last 10 years, they have entered the SME, MSME segment and tier 2, tier 3 cities where there is more under-penetration. So we see a higher growth is possible in this segment. Third is the insurance. 10 years back, only one insurance company was listed. Today, there are roughly 5 to 6 insurance companies listed, and many will come further going down in the next 5 years. People have realized the value of insurance, whether it is life insurance or general insurance, that insurance is a risk mitigating product, which we need to have. Most of the people, they either don't have a life insurance, or either they have a life insurance, they are underpenetrated. They are underinsured. So if you see, we can have a decent runway for growth considering our demography, our GDP per capita. Currently, our GDP per capita is $3,000. As our GDP per capita increases, the value of life will increase and people will opt for insurance or a higher value insurance. If you look at capital markets, the insurance industry started from 1964, but till 1993, there was only one or two players. It is basically the insurance industry, the AMC industry started from 93 for all practical purpose. From 93 to 2020, our AUM reached to only 20 lakh crores. So we gained 20 lakh crores in 27 years. Our AUM increased from 20 lakh crores in 2020 to currently 80 lakh crores, an increase of 60 lakh crores in roughly 5.5 years. Whatever we achieved in 27 years, we achieved thrice of that in just 5.5 years. And that was possible because people came to know that investing in equity is easier. And it is an asset class where if you keep money for a longer period of time, you can really beat inflation. And the ease of doing investment really supported it. And I think that today, with more financialization of our savings, earlier people used to save either in real estate, gold, FD, savings, and pension fund. Now people have realized that equity is a lower ticket size, higher liquidity, and they are moving towards equity. Now, at the same time, if you look the US BFSI industry, today banks are only 26% of the weight, and it is the capital market which has the lion's share of roughly 60% by market capitalization. Because it's a developed economy, banking system is well developed, and the corporates tap the bond market there for their borrowing requirements. Whereas in India, corporates below the rating of AA plus still have to come to banks for their borrowing requirements. So as we develop, these things will change. The overall bond market will deepen, and we will see development of other segments within the BFSI sector, such as insurance, NBFCs, and capital markets. So if you look at this, this slide would summarize or give you a broad picture. As Tridip said, that consumption is a sector which we like, and capex is a theme which has been going, and it is likely to go for the next 15-20 years in India, as we have a lot of infrastructure to be built, a lot of capacities. Manufacturing is just 14% of the GDP. So it is the banks, NBFCs, and capital markets will benefit whether they require equity or debt. Financialization of savings, that trend has started in the last 7-8 years, and very clearly it is for the benefit of the capital markets. And demographic dividend, it is not just insurance. Insurance is one big thing which will benefit, but it is capital market, banks, everyone will benefit. And most importantly, the people below the age of 35 or below the age of 25, they do not want to go to a bank physically, or they do not want to visit and waste their 2-3 hours. They are very much tech savvy. So all these people have adapted to fintech very easily. So that's why we have got the highest number of UPI transactors in the world at roughly 40 to 44 crores, which is likely to double in the next 5 years. So I'll just give you a brief overview about the economy. We have been saying that the leverage has increased in our country. For sure, it has increased. But if we compare to the global standards, our leverage stands at household leverage stands at 42%. That's basically debt to GDP. Whereas if you see, look at China, that's a dark blue line. We started almost at a similar place, similar point 10 years back. China was 35%, 36%. Today, it is at 60%. Euro has come down from roughly 59.5%, but it is still 52%. Whereas if you see US, it was 77%, it still continues to be at 70%. So still there is a big gap between India, and even if we take Euro, which is in between Euro, which is where the leveraging has decreased, still that is 10% difference. And if we take US, we are still 30% lower than them. So there is a big there's a good runway to increase, where we can see the consumption, where the capex going up, and what people were talking about, that the leveraging has increased. So something this has to be worried. We really don't. We are not in the camp which believes so. Now, if you look at the chart on the right hand side, roughly 23%. 23% of the borrowers, they are retail borrowers are just roughly 23% of the overall population as of now. So it is whether at the house level or at the person level, we are not leveraged as of now. So just a minute. So as I talked about, the NBFC sector is currently 48 lakh crores. We expect it to reach to roughly 75 to 77 lakh crores in the next 4 years, with a growth of roughly 16 to 17%. And this will be led by, as I said, higher penetration in retail, housing, auto, SME, MSME, and even RBI has become very proactive in regulation. If you saw the slowdown which was imposed on NBFCs and banks in 2023-24 on personal loans, credit card loans, and MSME loans, that shows how proactive RBI has been in controlling any kind of asset bubble or any kind of an NPA bubble. So as I said, we think that we have got very big banks. Definitely we have HDFC's 40 lakh crores, SBI's more than 50 lakh crores. But if we look them in a global scheme of things, SBI is still ranked 43rd number, whereas HDFC is ranked 73rd number. Government is planning, these are media reports, government is still planning to merge some of the medium-sized banks in the PSU category. So we will have very soon a few larger banks. And this chart also shows the amount of growth which is possible as when we compare our GDP with the GDP of other countries. So as I talked about the return ratios, we are the best of the health as compared to the last 15 years. The NPAs have come down drastically from the highs of 11% to currently 2.3% and further going down. So this is an interesting chart. I'll show you. As people age, as they start earning more, as they start to have families, they become more investment savvy. And in the last 7-8 years, we have seen a bigger shift in their investment behavior. From some people have started taking more risk, but people who were earlier investing in equities have started to invest in mutual funds. So mutual fund share in FY20 was just 4%, whereas equity was 2%. Now equity has increased from 2% to 4%, whereas savings in mutual funds have increased from 4% to 23%. So this is the growth which...
That's great. This point. Is the kind of what would be the final mega trend that you would want to talk about before we conclude?
Yeah, so the final mega trend is the fourth pillar, which we like. The digitalization. If you see in the last 10 years, we have seen many payment banks coming in, many wallets coming in and becoming a source for easy transaction, and that has been enabled by cheap cost of data, easy access to internet. Currently, we have 80 to 85 crore people using the internet, and that number is likely to increase to 110 crores in the next 5 years. Active internet user number is likely to go by 50% in the next 5 years. And we are the largest UPI transactors in the world, and that will double in the next 5 years. So a lot of things are being done in the fintech world. You have the names like Policy Bazaar, MobiQuick, all are there. And the most of the larger amount of business which is being there done currently is personal loan and business loans. In terms of volume, it is the personal loan. 92% of the business is personal loan, where the ticket size is less than 50,000. And value-wise, that number is only 39%. It is business loan, which is really picking up. And I think in the next 5 to 10 years, we will have a lot of things which will be done at the fintech company levels, something like a policy bazaar. Earlier, we used to go to agents. They used to come with only 2, 3 insurance policies. Now we can go to policy bazaar and see 15, 20 life insurance quotes from there. So we have seen Pine Labs. It is, we thought it was just a credit card machine, but it also does cash management business. It also does gift voucher management. So will see a lot of businesses, high growth businesses coming into this area in the next 5 to 10 years. And yeah, we will list in all these four segments in the BFSI sector. All these are profit making, and we will see a good 15 to 20 or a 25-year runway in these four segments. Yeah, that's where I like to conclude my presentation.
Thanks, Ashwini, for covering such in such detail and in such a lucid way. So we have a couple of questions. Trideep, the first one is for you, right? Uh, we have seen financial services underperforming quite a lot over the last 3 to 4 years. While the long-term story we believe is very lucrative and macros and structural levers are in place, what do you think? What is that one or two triggers that can actually start the upside movement for entire financial services as a space?
Niranjan, let me ask you this question just to kind of see how would you feel if a sector's top line growth is about to double? Will that sector do well or no?
Absolutely.
So, Ashwini, if you can go to that credit growth chart overall, you will see that what we are about to witness in financial services, there you go, as a sector is that, and if you look at the right part of the chart, an effective precursor to top line growth is the credit growth for financial services sector, Niranjan. And that is hovering just about the bottom. It was round about close to 20%, not more than a year ago, and it's in the process of bottoming out and gradually looking up. And I'm sure Ashwini talked about that this could go to anywhere between 12 to 15% over the next 6 to 12 months. So this would be my answer, Niranjan, that any sector where the credit growth is about to kind of double, on a broad-based basis, the entire financial services as a sector would see better days ahead, some more than and some less, depending on the turnaround. But as an enabling condition, as a starting point, this is a very good cyclical point to be looking at financial services as a sector, and hence one of the cornerstones of the conviction why we should look at financial services fund at this point in time.
Great. Thanks, Rideep. And, I just want to recap, over the last 2 years, you and your team were able to time couple of themes quite well. We launched technology fund, 2 years back, and, the performance has been really good. We also launched consumption last year, where I think so probably the team got the timing also right. And, you have played this theme in your existing funds as well. And likewise today, as you alluded, financial services is also one of the larger bets in your existing funds across equity funds that you and your team manages. Hopefully, we believe that this probably would be a right time, and we'll see this credit growth uptake, and that could push the overall sector on the upside. The other question that we have got is financial services is a vast sector. We have probably 95 odd stocks within the top 500 stocks, NSE 500 stocks. Uh, so it's a large universe. So how will the portfolio be decided, especially between the lender side and the capital markets place? Because if you see it, basically these are the two larger bifurcation between financial services today: lending business and non-lending, which is largely asset management and capital market related.
I would start, but I would let Ashwini join in. Ashwini, if you go to that slide where you have the US BFSI share and the India BFSI share as a base slide to talk from, there we go. So I would just start here and say that this is how the composition of financial services sector today looks like. As Niranjan pointed out, close to 50% is banks, Financial services, which is non-banking financial services, is close to about 26%, followed by insurance, and then the rest being capital markets being very kind of, small overall. Now, if one were to sort of think about where could Indian BFSI sector look in 20, 30, 40 years, one has to only look on the left-hand side. You can see that what you see in United States is close to 60% is about capital markets and others. The same number, Niranjan, is only 10% now. So in many ways, as our markets evolve to become globally more relevant, more important and bigger, you will see this shift happening gradually in terms of the composition here. What we are looking to do for the benefit of our customers in this fund is play this transition ahead of time and be party to that transition through this fund. So in other words, what I'm trying to say is that directionally, while lenders, traditional lenders like public sector banks, private sector banks are relatively slower growth, and the higher growth segments are the capital markets, NBFCs, and the likes, we would like to play this growth as long as the valuations are reasonable by kind of being maybe slightly underweight in the banks, in the traditional lender side, and overweight on the other segment, because that will give us a bit of a intra-sector alpha opportunity to play with. So clearly, one is a cyclical opportunity that financial services as a sector would do well. And secondly, within the sector, this is how we are looking to play. Ashwini, you want to add to which segments are your favorites, particularly in the non-banking space?
If you look at, I like capital markets the most because they are the highest growth in the entire segment. They've got very high cash flows and very high ROE. The only thing is the valuations are slightly on the higher side. Secondly, it is the NBFCs because even in the lending side, they are growing faster than the banks and they've got a higher profitability. So I'll be clearly overweight on those areas. But as a this is all data dependent and dependent upon the results and the outlook. But yeah, in the longer term, I'll be more overweight there. This portfolio will be driven more by growth and ROE, with valuations being comfortable.
Got it. Also, I want to add a point that it's broadly a very sector and benchmark agnostic fund, and time and again actively the weightages between whether it is lenders or capital markets or within capital market, there are multiple segments where opportunities could be, and that's where the expertise of a fund manager who's been tracking this sector for 20 years will come into play. So thanks Pradeep and Ashwani. Another question that we have is particularly on PSU banks. We have seen a very good run up in PSU banks over the last couple of years. Uh, you know, is there still a lot of steam left in that rally?
This is best answered by Ashwini. Ashwini, go ahead.
So if you look at the underperformance of PSU banks started in 2010-11 when the NPA cycle started. And from there, if you look at the NPA, that point was roughly 2%, increased to 11% at the system level. Now, if you look at SBI, is roughly 22-23% of the market. And out of the rest, 60 or 55%, roughly 30-35% would be the other PSU banks. So if you look at, they have the best of the balance sheet in the last 15 years, where capital adequacy ratio is enough. Their NPA is sub 2%. And the Indian Banking Bureau Board have made a lot of structural changes in the way the EDs and the MDs are appointed. Earlier, the EDs and MDs only had the loan growth as their KRA. Now they have to be profitable. They have to maintain their gross, the GNPAs. And if you look at earlier, the EDs used to only come for 3 years. Now they come for 5 years with another extension for 5 years possible. So I think PSU banks are well poised for growth for next 3 to 4 years. And if you see, they haven't done any kind of lending or bad lending in last 4 to 5 years. So we are not sitting on any kind of a NPA cycle, which we can see in next 3 to 4 years from PSU banks. And their ROAs are touching 1% and likely to increase further going ahead with an ROE of 15 to 16%. And they all are trading at sub 10 P. So I don't think there is any PSU company or any company which is trading at a sub 10 P with a growth of 12% and ROE of 15%. So I think, yeah, top 4 or 5 PSU banks, we would be positive.
Okay, thanks. Uh, there's one more question in terms of, while from a timing perspective, it looks a great time to invest into financial services right now because valuations are low. There has been a deep underperformance. How should one approach whether we should go for lump sum investments or SIP at this point in time?
Let me sort of take that. In my opinion, uh, even though NFO, ideally our salespeople and all of us would want lump sum, but if you honestly ask myself and Ashwini, it is better to go in an STP mode. And that's mostly driven by uncertainties in terms of unknowns like how Trump will behave, particularly in the global context, and a few other areas like yen carry trades and all that. We don't know how that will evolve. So ideal way would be to kind of go on an STP mode over the next 3 or 4 months as we take exposure to the financial services as a sector. Hopefully that gives us in and around the bottom, and we can kind of play this theme over the next couple of years.
So you're saying, Pradeep, basically a very short STP, maybe probably
Yeah,
3 to 6 months,
correct.
and it probably also makes sense if you have 100 rupees to be invested in this fund. Probably you can invest 50 rupees today, and then rest 50 rupees can come in a staggered way. Would that work, Pradeep?
Perfect.
Okay, great. Last question, while we have multiple questions, but we have tried to cover as many we can. Uh, Last question in terms of, what are the risks in this sector at this point in time, and, what factors can play a spoil game in this party?
Ashwini, all yours.
Okay, great. So currently, if you look at the domestic level, things are really fine. The Indian corporate leverage is at a 15-year low. The banking balance sheet is at a 15-year best. There is a political stability, economic stability. There is no problems as such. Rural is recovering. Urban is also on the mend. We are not sitting on any NPS cycle. All these things are of the past. The only headwind currently is the global geopolitical problem. Because of any such problems, if there is a spike in the crude, we are net 70%, 75% importers of energy. If there is any spike in the prices of crude, then that can impact our economic growth, our inflation. And in that case, where we expect a benign interest rate scenario for next few quarters, that may change, and that can be the biggest negative which we can see for this entire sector or for the country rather. So otherwise, I don't see any negatives playing out because domestically we're in the best of the shape as we can be.
Great. Thanks. I think so. We have covered a lot of ground. We have covered the sector in much more details, and why this could be a right time for investors to look at this theme. Trideep, any final thoughts?
I would say that while one is nervous about global geopolitics, in this nervousness you get better prices. If there is a feast outside, it's very difficult to get good prices for investing. Hopefully, between Jan 27th and February 10th, we get the best of the prices so that we can do the same like we have done in consumption fund as well as in the tech fund. Good luck to investors with decision making with regards to this. We certainly feel confident that we should be able to do a good job at it. While nobody is in the hands of macro, nobody knows the hands of macro. We think that bottom-up stock picking over the next 3 to 5 years, particularly in a sectoral diverse fund like that of BFSI, would be a good outcome for people to get invested in. Thank you very much and happy investing.
Great. Thanks, Trideep, and thanks, Ashwani, for covering this. And
thanks a lot, everyone.
Thank you, everyone, for joining, and happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.